All right, if you care about markets, you need to pay attention to this right now. I'm talking to you directly because something just happened in silver that almost nobody was prepared for. In less than 24 hours, silver dropped about 21.5%, falling from roughly $120 an ounce to near $97, and in the process, about $1.4 trillion in market value just vanished. Gone. That's not a normal pullback. That's not profit taking. And here's the part most headlines are missing. Physical silver prices in China didn't collapse at all. Shanghai premiums stayed elevated. Both futures market data and physical market data are confirming the same thing at the same time. Stay with me because I'm going to show you why this wasn't a demand crash, why it matters right now, and how you can recognize this pattern before the next one hits. Before I explain what caused this move, let me teach you something most people don't really understand about commodities, especially silver. When you see a price on your screen, you're usually looking at paper silver, not physical silver. Futures contracts, options, leveraged exposure. Think of it like a crowded elevator. As long as everyone's calm, it works fine. But if the elevator jolts and people panic, everyone rushes for the door at once. The problem isn't that the building disappeared, it's that too many people were leaning on borrowed space. Silver rallies attract leverage like nothing else. It's volatile, it moves fast, and traders pile in with borrowed money. So when silver goes parabolic, it's not just price going up, it's leverage stacking on top of leverage. And that's where things get dangerous. If this is making sense so far, drop a comment below and let me know where you're watching from. I want to know who's paying attention to this stuff. Now here's what's actually happening, step by step. Silver runs hard, pushing up toward $120. Momentum traders chase it. Funds increase leverage. Margin requirements stay manageable as long as price keeps rising. Then volatility spikes, liquidity thins, and suddenly margin thresholds get hit. When that happens, it doesn't matter if you're bullish or bearish. If you can't post collateral, you're forced to sell. So selling triggers more selling. Futures contracts get dumped, prices fall faster, more margins get hit, and the cascade accelerates. This isn't emotion, it's mechanical. Let me break that down even further because this is critical. When you're trading on margin, you're borrowing money to control a larger position. Let's say you put up $10,000, but you control $100,000 worth of silver. That's 10-to-1 leverage. When silver's climbing, you look like a genius. Your $10,000 is making returns like you've got $100,000. But the moment price drops even 10%, you've lost your entire stake. The exchange doesn't care about your conviction. They issue a margin call. You either post more cash immediately or they liquidate your position. No exceptions. Now multiply that by thousands of traders all hitting their limits at roughly the same time. You get a flood, a tsunami of sell orders hitting the market within minutes. And here's the problem. When everyone's trying to exit at once, there's nobody on the other side willing to buy at current prices. So price has to drop further and further until it finds buyers. That's the cascade. That's the flush. And that's exactly what we just witnessed. But here's the part that should make you nervous if you don't understand it. These events don't end trends. They reset them. Here's what's wild about this move. While COMEX prices were getting crushed, Shanghai physical premiums stayed high. That's your confirmation signal. Paper selling was overwhelming paper liquidity, but real-world supply wasn't loosening. That divergence is the tell. When you see futures crashing but physical markets holding firm, you're watching forced liquidation, not fundamental breakdown. The people who needed to sell weren't selling because they suddenly stopped believing in silver. They were selling because the system forced them out. There's a massive difference. And now let me show you what most people are missing. This pattern has played out before, multiple times. If this feels familiar, it should. This is the exact same playbook silver ran in 2008. Back then, silver was climbing alongside broader commodity strength. Then the financial crisis hit. Liquidity dried up everywhere. Silver got absolutely hammered in the sell-off, dropping from around $20 down to near $9 in a matter of weeks. Everyone called it the death of the silver trade. What happened next? Silver bottomed, consolidated, and then went on a multi-year rally that eventually took it above $48 by 2011. That wasn't luck. That was the market purging leverage and resetting for the next move. Same thing in 2011, when silver itself went parabolic. It ran from roughly $27 to nearly $50 in just a few months. Euphoria everywhere. Then it collapsed, falling back to the low 30s within weeks. Forced liquidation, margin calls, panic selling, people said the bubble popped. And yeah, silver did go into a prolonged consolidation after that. But the forced selling itself, that was a leverage flush, not a demand collapse. Same thing again in March 2020, when everything got liquidated for cash. Silver dropped from $18 to under $12 in a couple weeks. COVID panic, liquidity freeze, forced selling across every asset class. And what happened after that flush cleared? Silver rallied to $30 within months. Every time this happens, people call it the end. Every time it turns out to be a leverage flush. Zoom out and you see the larger story. Silver doesn't drift gently. It compresses, then explodes, then purges excess leverage. That's the rhythm. That's the pattern. And right now, we're right in the purge phase. Now, let me be skeptical for a moment because I want you to hear independent thinking, not just hype. Could this be signaling something worse? Sure. If physical premiums collapse next, if industrial demand dries up, if global liquidity tightens further and central banks shift policy, then this changes. That would suggest the fundamentals themselves are breaking, not just the leverage structure. And let me be honest about manipulation claims. I see the comments every time. People love to blame the big banks, the governments, the shadowy players. And look, markets can be influenced. But here's the thing. Markets don't need villains to do violent things. Leverage plus thin liquidity is enough. You don't need a conspiracy when the structure itself explains the move. So focus on what you can control. Watch price behavior, watch volume, watch physical signals. That's where the truth shows up. If you're spending your energy arguing about who's pulling strings, you're not watching the actual data. There are probably 3 types of people watching this right now. The first type is panicking. You saw silver drop and you're thinking, should I get out? Did I miss something? Am I too late? Is this the top? Did I just lose everything? If that's you, slow down. Take a breath. You don't make your best decisions inside a volatility spike. What you're feeling right now is exactly what forced sellers felt yesterday. Don't compound their mistake by making emotional decisions. Wait for the dust to settle. Let the mechanical selling finish. Then reassess based on structure, not fear. The second type is excited. You're thinking opportunity, bargain, generational setup, time to load up. And I get it. Violent drops create compelling entry points if the fundamentals are intact. But patience matters here. Let the forced selling finish. You don't want to catch a falling knife. If this really was just a leverage flush, there'll be time to position after stabilization. You're not missing the move by waiting 48 hours. You're protecting yourself from buying into continued liquidation. The third type is skeptical. You don't trust the move, you don't trust the narrative, and you're waiting for confirmation. That's healthy. That's smart. You want to see how this plays out before forming conclusions. For all of you, regardless of which camp you're in, the same rule applies. Don't react to headlines. React to structure. Markets reward people who wait for exhaustion, not emotion. So here's what I want you to answer in the comments. Which type are you right now? Are you panicking, excited, or skeptical? Be honest. There's no wrong answer. I just want to know where your head's at. So here's where I stand. I'm not chasing this move, and I'm not dismissing it either. I'm watching it. Closely. Let me tell you what I'm personally watching. First, I'm watching the $95 to $100 zone, because that's where stabilization usually starts if this really was a flush. If silver can hold above that range and start building a base, that tells me forced selling is done and we're moving into accumulation. If it breaks below $95 with conviction, that changes things. That would suggest deeper problems. Second, I'm watching Shanghai premiums. Right now they're elevated, sitting consistently above 20% in some cases. That tells me physical supply is still tight despite the paper sell-off. If those premiums start to compress and fall back towards 0 or negative, that would indicate physical demand is softening. That's a red flag. But as long as they stay elevated, the divergence between paper and physical remains intact, and that supports the leverage flush thesis. Third, I'm monitoring volatility itself. When volatility peaks and starts to roll over, that's when forced selling usually ends. You can see it in the VIX for broader markets. You can see it in silver's own implied volatility. When the panic subsides and realized volatility starts declining, that's your signal that the mechanical pressure is easing. Until then, expect chop, expect whipsaws, expect more headline-driven moves. Based on my analysis, this drop was mechanical, not fundamental. The way I see it, fundamentals didn't break here. They're quietly validating underneath the noise. Industrial demand for silver hasn't changed overnight. Solar panel production hasn't stopped. Electronics manufacturing hasn't collapsed. Central bank policies haven't suddenly turned massively restrictive in the last 24 hours. What changed was leverage. What changed was liquidity. What changed was the technical structure of the futures market. And when leverage unwinds violently, it creates opportunities for those who understand what's happening. If history rhymes, and it often does in silver, these moments tend to mark inflection points, not endings. I'm not saying silver immediately rockets back to $120. I'm not saying we've seen the bottom tick. What I'm saying is that violent deleveraging events in assets with intact fundamentals tend to create setups, not finales. The people who got forced out at $97 didn't want to sell. They had to sell. And when the mechanical pressure lifts, price tends to find its way back toward fair value, sometimes quickly, sometimes slowly, but the direction is usually clear. Now, I'm not a financial advisor. This is not financial advice. Do your own research. Verify everything I'm saying. Check the data yourself. Look at the Shanghai premiums. Look at the COMEX positioning reports. Look at historical precedents. Form your own conclusions. My job here isn't to tell you what to do. My job is to show you how to watch, how to interpret, how to recognize these patterns so you're not caught off guard next time. If you made it this far, you're the type of person who doesn't just react to headlines. You dig deeper. You want to understand the mechanics. That mentality will serve you well in markets, especially in volatile assets like silver. Most people see a 21% drop and they either panic or they tune out completely. You're here, 15 minutes into a breakdown, trying to understand what actually happened. That puts you ahead. If this analysis helped you see the situation more clearly, do me a favor, share this video. Send it to someone who's confused about what just happened. Subscribe if you want more breakdowns like this, and stay sharp out there. Think critically, verify the data yourself, and make your own decisions. I'll see you in the next one.